In this video, we will talk about Ferrari because the stock has dropped significantly. The company just had a meeting and a new event, and the market didn't like this at all, and the stock tanked. And now, on a year-to-date performance, Ferrari stock is down 6%, and we are 25% below highs. So in this video, I will comment on the situation, what has happened for Ferrari, and tell you my opinion about whether I will buy it or not. We will work a little bit with the data. We'll show you some charts. I will talk about the valuation. We will do a DCF. You will have a complete picture of how I see the situation with Ferrari and if I buy for my portfolio, because Ferrari is a quality company and I invest in quality companies. So this is a perfect situation for me to see this kind of drop. This is great to see, actually. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. So my benchmark when I buy something, when I want to purchase a stock, is to make 20% per year. If I can't make 20% per year, I'm not interested. So at the end of this video, you will see the DCF. We'll play around with different scenarios, and you will see at what price is Ferrari a good buy, a great buy, a huge bargain, okay? Because now we are only 20% below highs, and actually maybe it can go lower, because this is quite shocking what they have shown to the world. Okay, so now let me put the mic here. Let me show you a little bit the story behind the stock price drop. In case you don't know Ferrari, well, it's a car company, but it's also a luxury company. If you compare Ferrari with different car companies, the margins are sky high. The margins are way better than the competitors. And you have a car company with gross margins of 50%, operating margins of 20-30%, something that other car makers are eager to have, I would say. And if I scroll down, here are the financials. If you look at the past 10 years, revenue is the definition of up and to the right. And since COVID, everything has accelerated. Net income is also the definition of up and to the right. You have an all-time highs for net income. Same thing for the free cash flow, operating cash flow, I mean. And because the company is reinvesting in capex, in new cars, new models, switching to electric vehicles, they have a little bit of capex. So they have a free cash flow generation that is a little bit of a mess, actually. Okay, it was a spin-off from Chrysler a couple of years ago. And so far, the stock has returned some good performance. If you had bought during the IPO, the IPO price was what, $50? And not so long ago, we were at $500. So it was a 10x. Okay, now that I just did a quick pitch about the company has no major debt problem, actually. The company has a net debt of $2 billion and a free cash flow generation of $1 billion. So not really a big problem here. Now I want to spend a few minutes on this. These are the slides that the company shared during the Ferrari Capital Markets Day. And during this day, the market didn't like it. And this is the reason why the stock price dropped significantly. How much of a drop was it? Maybe it was like a 15% drop in one day, 12% drop. Let me go through some slides and explain the situation so you understand clearly. Let me put my face in small and we can start with some slides. You have 100 slides. I won't go over 100 slides. I will just show you the most important ones. Okay, they show again what they do, what their plan is for the future, and they talk about this first slide. Okay. In the past, Ferrari had ambitious plans to have a good amount of their cars being electric. And in the past, I would say an increasing amount of cars from Ferrari were going to be electric. Now it's no longer the case. During this Capital Markets Day, they announced that there will no longer be like 30 or 40% of future cars that will be electric, But for 2030, they expect electric cars to be only 20% of the cars they sell. Okay? If you think this is a bad sign, well, actually for the Ferrari brand and the Ferrari customer base, they don't like electric cars much. They want their old-fashioned Ferrari, and they like to drive. They don't like autonomous vehicles for Ferrari. You just want a normal car, and the customer base that Ferrari has is maybe the best one you can have. The absolute best one. Let me add some comments with these slides. When you had some tariffs and some problems, some threats in 2025, at the beginning of 2025, Ferrari announced a 10% price increase for their cars. And you know what? Customers love it. So you increase the price of your product, and customers are not bothered at all, because the Ferrari cars have a backlog of 2 years, 3 years. You have a list to have a car, right? So you are maybe willing to pay up to receive your car now. And it's about status. It's about the prestige of owning this brand. Maybe this is not your only car you have. These customers have many cars, very wealthy people, and they like to buy expensive stuff. You see the same thing happening with Hermès. I'm French, so I know my French luxury companies. Hermès continues to increase their prices, and people like more. It has a name like Veblen effect, Veblen goods, where you have some specific goods, you increase the price, it increases the demand. I mean, this is kind of crazy to think about it, but it's about prestige. It's about status. It's about showing other people you have taste. And Ferrari is doing this. They are not here to sell thousands and thousands and millions of cars. They are actively selecting the customers they want to sell their cars to. So they can increase their prices 10%, 20%, 30%. It will be fine, and it will not matter. So now you go back to your roots, you reduce your future electric cars, you go back to actually from just this slide. When it comes to the culture of the brand, this is bullish. This is not bearish, actually. This is bullish. I told you that they were investing in capex for electric cars. If you reduce the amount of electric cars you make, you reduce your capex, you increase your free cash flow. Second thing that is bullish, right? So the stock dropped 12-15%, but you have some bullish signs, actually. Let me scroll down. Built for the long term. Let me scroll. It's about culture, blah, blah, blah. You have some disclosures, community. You don't have a lot of cars that were produced, but everybody knows this. So it will not add any value to talk about the clientele here. You have a new passionate people that want Ferrari cars. We are not talking about the new generation, the Gen Z. They want Lamborghinis. The average age for Ferrari is 50 years old. So they want an old-fashioned car, reliable car. It's a Ferrari brand. No, everybody knows it. So the client base they have is very special, is very important, and they continue to nourish this culture. It's about design. Well, you all know the moat about Ferrari. The moat is the brand. Absolutely the brand. The moat is the name, the quality of the cars, the design, the performance, and it's cool to have a Ferrari. Okay? Even renowned investors drive Ferraris. If you don't know, Monish Pabrai, one of the best investors of the world, he has a blue Ferrari car. And he said, I did not... Oh, this is a good anecdote. I mean, let me give you some value. You clicked on this video, right? It was a tweet a couple of years ago. And he said, Monish Pabrai said, I never understood the moat of Ferrari until I actually drove a Ferrari. So Monish Pabrai has a blue Ferrari, very proud. And he says, now I understand behind the business model and everything. I understand the culture, being part of a very successful people, they own the same brand. This is why the customers are repeatable customers. I don't know how to say this in English. Repeat customers. They come again for a second Ferrari, for a new part. Again, the company has created a brand and people come back, and you buy a Ferrari once and then you buy a second one, a third color, you buy some other things. Most of the revenue that are come from existing customers. So this is great. And I believe Monish Pabrai will continue to be a customer because he actually loves his car. So yeah, you understand the moat when you truly are a client. Let me scroll down. One of tailor-made special equipment, blah, blah, blah. Okay, let me scroll down a little bit. The brand, the track, well, everybody knows Ferrari. So everybody knows they are very famous. They don't need advertising. They don't need marketing. They don't need special new models. You just want your car that is as good as in the past. This is fine. Let me continue. Let me scroll down because you have maybe the most important slide that is coming. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Actually, the business model is quite simple to understand. Everybody knows and understands what Ferrari is, what they do, and the goal they have for the next 20 years. The Ferrari lifestyle, the racing, the partnerships, the events. Let me scroll down. You have some partnerships with big famous people, and I will tell you the reason why the stock fell 15%, because we will talk about financials. Okay, so they talk about fundamentals. Finally, after 90 slides, they finally talk about numbers and the way they will allocate free cash flow. Okay, they are talking about dividends and buybacks, but after 90 slides, so I guess this is not their priority. If you can check, I've done on my channel some videos about Fortinet, and in the second slide, Fortinet was talking about buybacks. So you just put your priority for your first slides. If you need 90 slides to finally talk about EBIT, free cash flow, buybacks, dividends, capital allocation, that's not their priority. The priority is the culture, right? Now, this is the reason why the stock dropped 15%. They updated their guidance in 2025, and they gave a guidance for many years in the future, for 2030. First, let me tell you that they increased the guidance a little bit for 2025. Nothing really fancy, but it works. And the management team is known to be conservative, and they beat their guidance, they beat the estimates. They are quite bullish for 2025, but not crazily bullish, I would say. Okay, now they talk about the revenue projections in the future. And actually, they are talking about 2030. They are so confident in their business model, in their brand, in their culture, client relationships, client retention rate, that they can have a forecast for 2030. You don't have a lot of businesses that can pretty accurately give you a number like this. Like, okay, it will be this. And most of the time, they are a conservative management team. So it's very likely that they will beat this estimate. Anyway, they are so confident that they give you the forecast for 2030. They give you the mix of price, volume, the costs, etc. And this is why the stock dropped 10%. This is exactly this slide that caused the stock to drop 15%. Because now, given the guidance we have for 2025, net revenue of $7 billion, in 5 years, they expect to have $9 billion, or it's in euros. Anyway, it doesn't matter. 9 billion euros for 5 years. It's a CAGR That is quite low, I would say. If you look at the adjusted EPS, they will go from 8 euros in earnings per share to 11. That's a CAGR of what, 6 or 7%? So you have the best brand in the world, but you expect your earnings per share to grow at 6% per year. Yeah, I mean, if you believe this is what will happen, you have a forward PE ratio of 32 for something that will grow at only 6%. If you believe this is what they will do, the stock is expensive. I mean, you have other opportunities like MSCI, for example, same PE ratio, but they can grow at between 10 and 15%. So triple the rate, right? Let me show you something. Let me show you, that's the valuation. Let me show you the growth in earnings per share they've had in the past to see if in the past they were growing more than 6%. And let me show you this wonderful on a quarterly basis. How can I show you? On an annual basis. Anyway, for the past 10 years since 2015, you had an EPS growth that was 10%, 40%, 30%, 40%, 2 years of decline. What is the average? What is the median? The average and the median are 20%. So for the past 10 years, on average, this business has grown earnings per share at 20% per year. And then suddenly they tell you, no, it's not 20 now. We are going to grow at 6% per year. What a disappointing result. You now understand why the stock dropped 10, 15% in one day. You now understand why people are just saying this and say, oh my God, this is so expensive. Yeah, actually, if this is what they do, the stock is extremely expensive. If you think they will grow by 6% per year, this is extremely expensive. Even this year, they are growing at by a good amount. And the growth is decelerating, but this is not the first time it happens, right? Now, if they don't sell new cars, it's all about prices. In 2025, they already announced a price hike of 10%. What if they continue to do this in the future? It's possible, but this table is quite disappointing. And actually, you don't have many events when the stock price of Ferrari drops like this. So when the stock dropped 15%, I got a notification because this is a stock I follow and monitor. It's on my watch list. You don't get many opportunities to buy the dip on Ferrari. So when the stock drops, it intrigued me because it would completely be suited for my portfolio. Because in the next 30 years, 50 years, what brand will survive? Will Meta Platforms be here in 50 years? I don't know. This is only 20 years old. Will Hermes be here in 50 years? Absolutely yes. They are 200 years old. Will Ferrari be here in 50 years? Absolutely yes. Will Salesforce be here? I don't know. Will Alibaba be here? I don't know. That's, you are talking about companies, tech companies that are only 20, 30 years old. You don't have many companies with this runway of safety of knowing, yeah, it will be here in a few years, in a few decades, it will be here. Okay? So, no, this is for this one. The industrial free cash flow they plan to have is very bad. The projection, the forecasts are very bad. But can you trust them? The forecasts are so bad that instead of showing the industrial free cash flow target, they put the accumulated free cash flow target. It's the same thing we see for ASML and their buyback program, by the way. They talk about accumulated numbers because their numbers are bad when it comes to buybacks, for example. When you don't have many buybacks, similarly to Ferrari, you don't have a lot of free cash flow. And this is quite alarming. If the management is telling you this, can you trust them? And do you think they can do better than this? If you don't think they can do better than this, if you trust management, and if you think they will only grow by 6% per year, you can leave this video right away. It's not a buy, it's a sell actually, because the company is excessively expensive right now. Let me show you what is next. Increase shareholder reward. Yeah, capital allocation, 40% capex, 60% shareholders reward. Dividends and buybacks. I hate to see dividends for these beautiful companies, but you have an Italian culture here. So a European mind cannot comprehend the beauty of buybacks. This is a family-owned business, right? So they want their paychecks at the end of the months, at the end of the years. So they want dividends. Fair enough, I understand this, but the European mind would be much better off if they just cut the dividends whatsoever and just focus on buybacks, because you have flexibility, you pay less taxes. What is the dividend yield for Ferrari? 1%. It won't matter much as an investor. It's just for the family. And they are increasing the returns towards shareholders. For the dividends, they increase from 30% to 40% of the adjusted net profit. So they want to reward the shareholders a little bit more. They know that their guidance is horrible. Same thing for the buybacks. They increased the buyback they plan to do in the future. Actually, by not so much. They say they want to make $3 billion of buybacks between 2026 and 2030. That's what, 5 years? Yeah. And for the past 3 or 4 years, they've made only $2 billion of buybacks. It's not such a big increase, actually. Maybe they wanted to reassure shareholders here. I don't like it. Okay, I think I'm done. That was the last slide that was interesting. Now I want to show you, that was for the revenue, that was for the earnings per share. I want to show you the valuation, and we'll do a DCF, okay? If I had told you in a few months ago, in February, that Ferrari was a business growing at the earnings per share at 6% per year, and if I had told you they had a PE ratio of 57, nobody would have touched the stock, right? But as always, you had willing buyers at these prices, at this valuation. This is why I've made 25% per year, because sometimes people are stupid and they pay up for quality companies. Exactly this thing. This is a mistake I see a lot of the time, and you are watching a channel for serious people. Please don't fall in this trap. You like the company so much, you are willing to pay up any price. And in the past, it was 6 months ago, in February, 6 months ago, 8 months ago now, you had a PE ratio of 50, 60, like a Costco, but for a business that is only growing by 6% per year. But now the valuation gets much better. The valuation is much more reasonable. You have a PE ratio of 37. And if I look at the forward PE ratio for this business, for this stock, you have 34, the same, around the same we've had in 2022 after the crash. So actually, you have a plateau because this is a quality business, a quality stock. Actually, this might be the bottom for Ferrari. Psychologically, it will be very hard for the stock to go down more than this. In terms of forward PE ratio, you don't go below 30 a lot of the time. So, since COVID, actually, it never broke 30. So actually, we might be having a local bottom here, and maybe it will rebound. But actually, a 6% growth rate is quite disappointing given the valuation. People are paying up because of the resiliency of the brand and the future, but this is quite bad. And if you believe they will grow at what? 6%. It's earnings per share, right? So they doesn't account for buybacks. That's always here. Okay, fair enough. Okay, let me show you what I do. I'm on Stock Unlock right now. By the way, I'm using Fiscal AI here and Stock Unlock here. If you want to use these two beautiful websites, you have links in my description. Discount codes, it will get cheaper for you. You can use my link in the description below. Okay, so if we put a forecast for earnings per share of 6%, I'm using net income, but it's as if I put net income of 5% and a buyback of 1%, I mix up, I sum everything up. So earnings per share growing at 6% per year. The dividend, I don't care much. What is a good PE ratio for the stock? Well, this is a beautiful question, right? If you put a PE ratio for the past 10 years, if you look at the average and the median, we are talking about what, 40? So 40 is the average. If this is what you think the business will do in the future, PE ratio of 40 for something that grows at 6% per year, then the business is a little bit expensive. We are near fair value. And if you buy right now, you can expect a CAGR of 8%. I started this video saying I only buy stocks that I think will compound and will outperform the market, and the threshold is 20%. Which means I will not buy Ferrari at current prices. Next question, at what price will I buy? Okay, let's see. If you want a CAGR of 8% per year, what can change is the earnings per share growth rate in the future. So if they don't grow by 6% per year, if they grow by 10% per year, I think they will do better than 6%, guys. I think with the price hikes we will see in the future, given our inflationary world, it's very likely they beat their estimates. They are famous for being conservative, so they will not do 6% per year. This is my best guess. Maybe they will do 8, maybe they will do 10, maybe more, I don't know. But if they do 10% earnings per share growth, now we are talking about a CAGR of 12%, which is way better, right? If the stock price drops a little bit, you will have a CAGR of 15%, and now we are talking. Which means, if the stock continues to drop at what? 350? Something like this? If it continues to drop a little bit, and if you think they beat their guidance, actually you are talking about a CAGR of 15, 16%. At this point, I would be very interested to buy Ferrari. And what if they double their estimates? I don't think if this is likely, but let's play around with some numbers. If you think they will grow earnings per share at 12% per year, we are talking about a CAGR of 14% if you buy now, which will allow you to beat the market. And if they grow at 15% per year, now we are talking and outperforming everybody, 17% per year. Okay, so now you have a few scenarios of things that can happen. I think they will beat their estimate of growing 6% per year. I think the brand is still here. The brand will shine. Their move away from electric vehicles, I think, is great and very bullish for shareholders. I think now they will continue to increase the prices of their cars. And when the stock price drops to 350, I will update you guys, and maybe I will start to position. And at 300, if the stock price drops to 300, now it can get pretty interesting. So yeah, something to monitor. If you are a quality investor, this is a stock for you that you buy and hold because you know the brand, you know the business model. It's very easy to understand. You know where the future is for this company. You know what they will do in the next 10 years, 20 years. It's not that hard. Sometimes investing is that easy. You find quality companies, and when they disappoint, you buy them and you hold them. So yeah, a quick video on Ferrari, but I will keep you updated and make new videos as the story evolves. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.